All right, welcome to The Explainer. Today, we're digging into a deep dive analysis from BGVC on Intel's latest earnings report. It's really a story of survival, but the big question we need to ask is all this celebration a bit premature?
You know, this one phrase from the analysis really nails it. Yeah, they're out of the emergency room. They've stabilized what could have been a total cash crisis. But, and this is a big but, they are nowhere near healthy. That road to a full recovery, it's still looking incredibly long and uncertain.
So how do you get from stable but sick to a stock price that's just taking off? Well, it seems the market decided to focus only on the good news. Right after that Q3 report, investors just piled in, pushing the stock clear above $35. So let's break down exactly what got everyone so fired up. Okay, so on the surface, the headline numbers, they looked amazing. Intel beat expectations on revenue, hitting $13.7 billion. But the real shocker was the earnings per share. Wall Street was expecting basically zero, and Intel came in and posted 23 cents. For a lot of people, that was the first real sign that maybe, just maybe, things were turning around. And it wasn't just the financials. They also hit a huge technological milestone that added to all this optimism. They announced that some key chip designs were successfully taped out. Now, if you're not familiar, taping out basically means the final design is locked in and it's ready to head to the factory. This was a big deal because it suggests their super ambitious roadmap is actually still on track. But here's where the BGVC analysis comes in and says, hold on a second. The argument is that all this optimism you see on the surface, it might be totally misplaced. To really get what's going on with Intel, we've got to peel back a few layers.
So you look at the client computing group, that's the division that sells chips for PCs, it's their biggest one by revenue, and it looked like a real bright spot. I mean, 8% year-over-year growth. That's a clear win, right? Well, maybe not.
See, the report calls this a false prosperity. This growth didn't come from some exciting new demand for things like AI PCs. Nope, it was mostly driven by a temporary wave of businesses having to upgrade their computers. Why? Because they're being forced to replace old machines that are running Windows 10 before it goes out of service. It's a one-off sugar rush, not a real structural recovery.
Okay, so if the PC growth is just temporary, what about the most important battleground of them all? We're talking about the data center. This is where the future of computing is going to be decided, and for Intel, this is where that whole optimistic story really starts to crumble.
And this slide, wow, this shows a truly historic moment. For the first time in history, AMD's data center revenue at $4.3 billion has officially blown past Intel's, which was at $4.1 billion. And listen, this is way more than just a number on a chart. It's a huge, symbolic shift in who holds the power in this market.
And the fallout from this? It's severe. Think about it. In the super profitable server market, Intel is completely losing its pricing power. They're basically forced to slash prices just to keep customers from jumping ship to AMD's EPYC processors. And then you look at the AI space. Their Gaudi accelerators, they're barely making a dent against NVIDIA's absolute dominance. So this all begs a huge question, right? If Intel is getting hammered in its most important market, how on earth did they manage to blow past their profit targets? Well, the answer isn't about selling more stuff. It's all about survival tactics.
The leadership team has gone into full-on stop-the-bleeding mode. I mean, we're talking major cost-cutting, including a 15% layoff globally. They suspended the dividend to hang on to cash, and they sold off a majority stake in their really profitable Altera business.
And that Altera sale is the perfect example of this trade-off. Sure, it brought in a quick $3.3 billion in cash, which was a lifeline they desperately needed right now. But the long-term cost? It's huge. Intel just gave up control of one of its most reliable, profitable assets.
And get this, even after all these drastic moves, their free cash flow, the actual cash the company makes after paying for everything, is still negative. And the reason is simple. The amount of money they're burning through is just staggering.
Yeah, this is the number that has to be keeping executives up at night. Intel still has to shell out over $20 billion a year for both 2025 and 2026 on capital expenditures. We're talking about building out their massive new factories in Arizona and Ohio. It's a gigantic bet on the future, but it is absolutely draining their cash today.
So this all brings us to the bottom line. What does this all mean for the stock price? After that huge run-up, is Intel still a buy, or is the market just getting way ahead of itself?
So the BGVC analysis uses what's called a sum of the parts model to figure out what the company's actually worth. Basically, you value each piece of Intel separately, the PC business, the data center, the new foundry, plus what's left of Mobileye and Altera, and when you add it all up, you get a fair value of about $34 a share, and that's below where the stock has been trading.
And when you compare Intel to its peers, the valuation problem really stands out. If you look out to 2026 earnings estimates, Intel is trading at a PE multiple of 25.5. Now check this out. That's actually more expensive than TSMC, the undisputed king of the industry, which trades at a much more reasonable 22.5 times multiple.
So what does that tell you? Essentially, the market isn't pricing Intel based on its current messy reality. It's pricing it for a future where everything goes perfectly in their turnaround plan. And that is a very risky bet, especially with all the challenges still ahead of them. So what's the final verdict here? Well, the analysis suggests that at these prices, Intel isn't that cheap turnaround bet anymore. If you're already holding the stock, it might be smart to trim your position a bit, lock in some of those profits. And if you're thinking about jumping in now, the advice is pretty clear. Don't chase this rally. Wait for a pullback.
And that really leaves us with the big central question for anyone looking at this stock. Look, Intel has absolutely made it out of the ICU and into the general ward. The immediate crisis is over. But with the stock price already baking in a perfect, best-case scenario, you really have to ask yourself, is the market now overpaying for a recovery that's still years down the road and honestly is far from a sure thing?